If you own silver right now, there's a strong chance you've seen posts or videos recently warning that something major is happening on February 15th. Maybe you've heard claims about an IRS crackdown, new reporting rules, or even suggestions that silver owners will suddenly be forced to register their holdings. So before anything else, let me say this clearly. Almost everything being said about February 15th is being misunderstood. This is not a new government crackdown, it is not a silver-specific rule, and it does not signal any sudden change in ownership laws. And if you sell your silver because of panic created by misinformation, you risk being the one who loses, not the system. Welcome to the Silver Gen, where the goal isn't fear or hype, but clarity. Because in volatile markets like this, when emotions run high and headlines move fast, the difference between acting on facts and reacting to panic can completely change your long-term outcome. Let's start with what's actually happening. Every so often, a familiar wave of fear spreads through the precious metals community. Someone finds a date connected to an IRS form or filing deadline. That date gets shared without context. Then suddenly social media fills with warnings that silver owners are about to be targeted. This time, the date creating anxiety is February 15th. You've probably seen claims that a new IRS rule goes into effect that day. Some videos even suggest selling immediately to avoid penalties or forced reporting. But when you slow down and look at the real information, the story changes completely. February 15th is not a new regulatory action. It's a long-standing administrative paperwork deadline, one that has existed for years, and it mainly applies to businesses and reporting schedules, not individual silver holders. Specifically, it relates to information returns such as Form 1099-B, which certain dealers or brokers use to report qualifying transactions under specific circumstances. These forms are submitted by businesses, not by you simply because you own silver. And here's an important detail that most panic posts ignore. IRS filing deadlines often shift depending on weekends or holidays. For this cycle, the effective deadline actually falls on February 17th, 2026, not February 15th. That difference isn't regulatory, it's purely calendar-based. So what happened? Someone likely saw an old schedule, misunderstood its context, and amplified it as breaking news without checking whether it applied this year. And once fear starts spreading online, algorithms amplify it because panic generates engagement. But this isn't analysis. It's misinterpretation turned into content. Now let's break down where the confusion really comes from, because understanding that will help you recognize similar fear campaigns in the future. Most panic narratives combine three completely different systems into one story. 1-car capital gains taxes, 2-dealer reporting requirements, 310 cash transaction reporting rules. Each has its own purpose. Each has different triggers, but when mixed together incorrectly, they create a false impression that a major crackdown is coming. And that's exactly what we're seeing now. In the next part, we'll break down each of these systems one by one so you understand exactly what applies, what doesn't, and why most silver owners have nothing new to worry about. So let's break down the three systems that are creating most of the confusion, because once you understand how they actually work, the fear narrative falls apart very quickly. First is something that sounds complicated but really isn't: capital gains taxes. If you sell silver at a profit, you may owe capital gains tax. That's true, but it's not new. It's not specific to silver, and it has nothing to do with February 15th. This rule has existed for decades. It applies to stocks, real estate, collectibles, and many other assets. When you sell something for more than you paid, you may have a taxable gain. When you sell for less, you may have a loss that can offset other gains. Nothing about this changed recently. No new reporting requirement was introduced. No sudden enforcement shift occurred, and there's certainly nothing about this that should trigger panic selling. System number 2 is dealer or broker reporting, and this is where most of the misunderstanding begins. In certain cases, dealers are required to file information returns such as Form 1099-B, but here's the critical detail that gets left out of almost every fear-based post. This reporting is not automatic for all silver transactions. It depends on very specific conditions: the type of product being sold, the quantity involved, defined reportable thresholds outlined by IRS guidelines. Most silver sales do not meet these conditions. Let me repeat that because it's important. Most silver transactions do not trigger 1099-B reporting, and even when reporting is required, the dealer files the form, not you. Your responsibility stays exactly the same as it has always been. Accurately report gains or losses on your tax return. The 1099-B is simply a reconciliation tool used to verify that reported transactions align with recorded activity. It is not a surveillance expansion, it is not new enforcement, it is paperwork. Now, let's talk about the third system, the one that generates the most confusion online. Form 8300, this form applies when a business receives cash payments exceeding 10-0. Notice the key word there, cash. Form 8300 exists as part of anti-money laundering regulations and applies across many industries: car dealerships, jewelry stores, real estate transactions, and more. It is not specific to precious metals. And most importantly, it is about how you pay, not what you buy. If you purchase silver using wire transfer, bank check, credit card, electronic payment, Form 8300 does not apply. It only applies when large amounts of physical cash are used. And another crucial detail often ignored, Form 8300 relates to receiving cash payments. If you sell silver to a dealer, the dealer is paying you, not receiving cash from you, so the rule is entirely different. So when someone combines capital gains taxes, 1099B reporting, and Form 8300 into one scary narrative about a February deadline, they're blending three unrelated systems into a single misleading story. Understanding the differences between these systems is the key to removing the fear. In the next part, we're going to talk about the difference between buying and selling silver, because that's another area where misinformation spreads fast and why ownership itself remains largely private and unchanged. Now let's talk about one of the biggest sources of confusion, the difference between buying silver and selling silver. Because many fear-driven posts treat these two actions as if they're identical. They are not. When you buy physical silver, in most cases, there is no automatic federal reporting requirement tied simply to ownership. The transaction happens between you and the dealer. Money changes hands, metal changes hands. Unless very specific conditions are met, such as large cash payments exceeding regulatory thresholds, there is typically no federal form triggered just because you purchase silver. You do not need to register your silver. You do not need to notify the government that you own it, and nothing about the February deadline changes that reality. Silver ownership remains legal, private, and generally unreported. Now, selling silver is where reporting can sometimes enter the picture, but again, only under certain circumstances. A common signal is when a dealer requests a W-9 form. If that happens, it often means the transaction may fall into a reportable category, where the dealer anticipates filing a 1099B. But this is important. Being asked for a W-9 does not mean you are in trouble. It doesn't signal enforcement action. It simply indicates administrative paperwork requirements for specific types of transactions. And even when a 1099 form is issued, your obligation does not change. You report your gains or losses on your tax return just as you always have. Nothing about February 15th alters that process. Now let's address another area where emotions tend to spike the difference between paper silver and physical silver. Paper silver, such as ETFs or brokerage-held products, exists entirely inside the financial system. Every transaction is already recorded. Documentation is built into the structure from day one. There is no privacy element to lose because the system itself maintains the records. Physical silver operates differently. When you hold physical metal directly, ownership exists outside brokerage reporting frameworks. There is no automatic reporting simply because you possess it. However, and this is where nuance matters, when physical silver becomes part of a reportable transaction, paperwork can follow. Not because silver ownership suddenly became tracked, not because laws changed, but because certain transactions create administrative reporting requirements. The transaction creates paperwork, not the ownership itself. That distinction is critical. If you hold physical silver privately, there is no registration requirement. There is no sudden reporting obligation, and nothing about the February date changes that. So what actually changed for silver holders? For most people, absolutely nothing. No new ownership rules, no forced registration, no silver-specific enforcement action. What changed was the volume of noise. Someone misinterpreted a routine administrative deadline. The algorithm amplified it. Panic spread faster than context. And that's exactly how manufactured fear campaigns work. In the next part, we're going to move beyond the misinformation and talk about what actually matters, real developments in the silver market, current price movements, mining sector signals, and why understanding real risk versus fake risk is essential right now.